Hey, my guest today is Peter Walker. He's head of insights at Carta. Peter really likes to tell stories with data. And since Carta has a lot of data on a lot of startups, given the fact that most startups use Carta as their platform for cap table management, there's a lot of stories to tell from that data. So today we're just excited about hearing some stories that we can learn about the startup ecosystem from Peter. Thanks so much for joining us.
Real pleasure to be here, man. Yeah, happy to do it.
I want to start with like the headline question. The prediction kind of like mid-year was that 2023 might be the worst year for startup funding in like a decade.
I think worst is maybe a slightly more qualified term than it seems at the top. If you look back to 2013, there's still a lot more capital being invested into startups than there was a decade ago. That's for sure. Mm-hmm. I do think in terms of the change, however, 2023 was no fun for most startups in venture, at least when we're talking about US startups here, which is the majority of Carta's data. Across Carta, something like it's going to end up at $60 or $65 billion invested into Carta startups last year, which is a pretty big number, but in comparison to the more than, call it $220 billion invested in 2021, it's quite a ways off.
For Carta startups, that number went from 220 to 65 billion.
Yeah, from 2021 to 2023. And then in the middle, 2022 was 120 or so. So steady decline over the last 2 years.
Yeah, because 2022 was a weird year. It started strong and then kind of like cooled off towards the end of the year.
Yeah, exactly. It was the last little bit of the party happened in Q1 or so of 2022. And then, everybody realized that the party was over.
Was 2023 the year of the down round?
Yes, probably more the year of the down round than anything else. Well, down or perhaps a bridge, but about 20% of the rounds that we saw in Carta last year were down rounds, meaning, companies raising at a lower valuation than they raised at the prior round. 20% is, as in comparison to historical averages, about something like 9 to 10% are usually down rounds. So highest we've seen in a consistent basis in many years.
You mentioned bridge rounds. Tell me about what the data tells us about bridge rounds in 2023.
Yeah, so bridge in our definition, and I'm sure that there's a little bit of nuance here with other people. There always is with these.
Everybody's just like, this is not a bridge. It's not a bridge.
Exactly. Yeah, whatever we can do to call it something else. So bridge for us is any round in the same named series. So you've already raised a Series A and you're raising a Series A preferred 2, Series A extension, whatever it is. Typically they're led by insiders who are already on the cap table, as current investors are involved. Bridges were super common last year, way more common than they usually are. Something like, when you look at the early stages, seed and Series A, those companies were raising bridge rounds, like something like 40% of all the Series A rounds on Carta last year were bridge rounds. So that tells you a couple things. One, it means that investors are spending a lot of time on those current portfolio companies. They're not spending as much time as they used to on making new bets. And then the other thing is that it seems like every one of those current portfolio companies is coming to their current investors pretty much in the same, 6-month span or so and saying, we need more cash in order to make it to the next round. And so investors are kind of having to choose amongst people they've already bet on. Look, who am I going to double down on now?
And I don't know if you know this off the top of your head or if the data, if you're collecting this much data, but is it generally on this, your definition of bridge round being on the same terms?
It doesn't have to be. Many bridge rounds are, in fact, flat rounds. So same valuation, et cetera, just, more equity given up. But there can be down rounds that are bridges or even up rounds that are bridges. Up round bridges are typically more common at the seed stage. Again, with these fun terms that seem to be propping up, you might have a seed extension, seed plus round before they get to a Series A. That's pretty common. But most of the time, they're for flat rounds.
What stage of funding was the most challenging in 2023 from the startup's perspective? And what stage of funding was the most, active?
Most active, certainly as you move earlier and earlier in the company life cycle, there are just more and more companies, more and more rounds happening. So seed and Series A were far more active than late stage. The place that got hit hardest, honestly, is the companies that are closest to IPO. Those valuations have fallen very quickly, basically alongside the amount of funding that goes into those rounds. And it's sort of a waiting game now. I don't think the valuations picked up a little bit in Q4, but on an aggregate basis, it's going to be really tough for the late part of the market to recover fully if there are no IPOs. So
Right.
everyone's sort of just waiting, when is this IPO market going to reopen? And when it does so, it allows for price discovery at the late stage in a way that's just not possible right now.
What were there any trends that you saw in 2023 as far as round size and valuation?
In general, it kind of feels a little sclerotic, I'm sure, for a lot of founders, because round sizes and valuations at the early part of the market are actually very robust. Seed valuations are basically, they're pretty close to where they were in 2021. Series A valuations maybe a little further off, but not by far.
And what do you attribute that to?
Honestly, the more that I've spoken to VCs and other people in the ecosystems, it's just that there's a floor underneath seed rounds under which it's really difficult to fall. Not necessarily because the companies are, although they are in this case probably a little higher quality. It's also about fund economics. If a fund is a pretty decent sized seed fund, and they have to own, call it 20% of the company in the seed round in order to make their fund make sense mathematically, that implies a valuation that can not really go below 10 to 12 million.
Unless they're cutting tiny checks.
Tiny checks, right? But there's so many seed funds now that have hundreds of millions of dollars. You can't deploy tiny checks with $100 million fund in a seed round. It just doesn't make sense. There's not enough companies in the world to make that happen. I think that the seed round robustness has more to do with fund economics than it does with intrinsic value of these companies, which makes it difficult. Like if you're thinking about it, seed and series A, if they can only fall so far and late stage has fallen quite a bit further, that's how are you going to square that circle? Over time, you basically need late stage valuations to pop back up.
To go up.
And a lot of people are betting on, look, if I'm investing in a seed stage company, they're not raising late stage capital until 6-7 years from now. Who knows what the world's going to be like? It's worth the bet. But there is a gap.
Yeah, it'll be interesting to see how this cohort of seed stage companies, the 2022, last half of 22 and the 23 cohort, and see how they progress. That'd be a fun thing to look at, see how they progress in the next 5 years, and how that would compare against the cohort of folks that were raising 2 years ahead of them. Did we see anything different about the timing between rounds? Are people waiting longer to raise? Are they trying to extend runway? What's happening as far as timing between rounds?
Certainly, we're hearing all sorts of ways to extend runway. The most common and unfortunate of those being layoffs, which we all that's the most dramatic impact to the runway that a company can have usually. But cutting in software spend, being a lot more capital conscious, I think is true across startups. When you look across all of the we'll call it from seed to A and A to B, so those early rounds, there's more time between primary rounds for sure. That's sort of steadily risen since the start of 2021 or so.
What is an average amount of time between a seed and an A right now, for instance?
Seed and an A, the average amount of time is about 2.25 years or so.
Gotcha.
So 2.25. But that's the average. There's, the 75th percentile is much, much higher than that. The other thing there is that, this is just tracking the time between your primary Series A and your primary Series B. But as we just went over, a lot of companies are trying to raise a bridge, trying to raise an extension, adding convertible notes or safes, even in between priced rounds. So there's a lot of creative financing going on. Kind of remains to be seen to me whether or not that creative financing ends up being a burden on them later on if they've given up too much equity in that way. But, better to stay alive than to go under, I guess.
I think that's the roll of the dice, right? We obviously this year, or 2023, has been more VC friendly. And I'm wondering if that played out in the terms, if you guys saw that play out in the terms at all, liquidation preferences, et cetera. Were there any terms that kind of moved more VC friendly than founder friendly or company friendly?
I'd say there were very few terms that on the aggregate didn't move at least a little bit towards VCs, if you're thinking about the power structure here. So the ones, I think the biggest two that we track closely are liquidation preferences. So anything over a 1x liquidation preference is pretty high. And then participating preferred stock, whether or not the investor effectively gets to double dip on any exits. Both of those are more common than they used to be. I will say it's not as though those are in 50% of deals. High liquidation preferences, you're talking about 6 to 7% of deals in 2023. Participating preferred, maybe 8 to 10% in some cases, but it's still a short minority And I think the reasoning behind that isn't necessarily that the founders have any negotiating leverage or very much of it. It's just that instead of doing a deal with a high liquidation preference, the deal in 2023 was just more likely not to happen at all.
Yeah.
And so, because it is really challenging to see if you're an investor, hey, if I take on this term sheet that's favorable to me, will this company end up growing to the point where that actually matters? That's always the first question.
Does the data tell us any interesting stories about funding by industry?
I don't know if you call AI an industry. Again, let's call it an industry then. Well, then congrats to AI industry. They did well last year.
They did well.
I think that was the biggest silver lining, bright light of venture. A lot more time and attention and capital going into AI startups. Lots of debate as to what should be considered an AI startup.
My kind of experience has been that everybody, is framing themselves as an AI startup, and there's obviously like different levels of AI integration into a company. That pitch deck may look a little bit different than the reality of what's actually happening.
I would actually love to have someone go back and do like an internet archive analysis of when the word AI appeared on all of these startup websites, because I think it would be a pretty vast shift over the last, call it 12 months or so. So AI is doing well. The other thing that we saw, so most industries on Carta saw less funding in 2023 than they did the year before. So most people didn't escape unscathed. I will say it does seem as though fintech got hit relatively a little bit harder. And then the things that didn't get hit quite as hard were more, real world industries. So I'm thinking specifically here of biotech, medical devices, and energy.
They did not get hit as hard. Is that what you're saying?
Held up relatively better, yes, in terms of total funding. Maybe it's, if the median SaaS multiple is not 50x, but rather 6x, maybe the bet on an energy company is just kind of a more attractive one these days than it used to be.
I remember a really cool stat, or not so cool stat, that you guys put out in Q3, which was it was maybe the most fatal quarter for startups since you guys have been measuring, that there were a lot of the high number of startup failures, bankruptcies, dissolutions, whatever. In Q3. I'm curious about the year as a whole, 2023 as a whole. Was this the most fatal year for startups?
Unfortunately, yes. Yeah. More startups across Carta shut down this year than we had seen in our history. Of course, more startups are on Carta now than have ever been on Carta. So there is some natural growth rate there that you'd expect, but it was about twice as high as we saw in 2022. And the interesting part there is not, the standard stat that you hear is 9 out of 10 startups fail, which is true, but you would expect that percentage to decline as they go through the funding rounds. It should be less likely that a Series C company fails than a pre-seed company, just because the de-risking should have happened.
Sure.
We see, and that's true across our data, but what we did see this year is that even startups that had raised significant capital, so call it like $10 million or more in venture funding, they still were going out of business at higher rates than in prior years, more than double actually from 2022. So it's not as though, having raised capital is completely insulating from facing this kind of downturn.
And I do wonder if the challenge there for those startups that raised 10 million plus was they raised in a world where it was just like spend to grow as much as you can. Then pivoting away from that to being a more frugal company was just not really doable for them.
I think you hit it on the head. I think that's one of the main reasons why it's much easier to have grown up in one or the other environments. The switch from super low interest rate money is cheap to high interest rates, capital efficiency is more important. That's a very difficult switch to make if you've already set in place your go-to-market motions and this is how we end up bringing on customers. Which is why I think, in a weird way, right now is a better time to start a company than it is to really grow one super quickly.
Tell me more about that.
I think that founders today are if they're founding their company in 2024, you are in a difficult moment, no doubt, but you are aware of the difficulty of the moment. You understand that you're going to need to be capital efficient. You're probably thinking about using AI to cut down on your internal costs. You're just growing up in an environment that prioritizes that sort of thinking. Whereas if you grew up in 2020 or 2021, everyone was up and to the right. It seemed as though capital was cheap. You could grow really quickly, really fast. And it's just harder to make that switch. Culturally, financially, all of it is harder to make the switch than growing up in the new environment.
That makes sense to me. I've been kind of working with startups for the last 16 years now. And one of the things, longer macro trends I've seen in funding is just like the prevalence of the safe note going from non-existent to really huge in the pre-seed and seed stage. I am curious about if there's any interesting data around how safes were used in 2023.
Absolutely. I think you touched on the major trend, which is safes have sort of come to dominate pre-seed investing. It used to be that convertible notes and safes were, each hovering around 50% of all the money invested into pre-seed companies. At least on Carta, today that has radically shifted. About 80%, maybe even higher, of the money invested into pre-seed companies comes through a safe rather than a convertible note. Why is that happening? I mean, typically, money sort of flows to the most convenient path. Safes are much faster than, and they cost much less in terms of legal costs than a price round.
Yep.
And then they, versus a convertible note, they don't have an interest rate. So it seems like a better deal for the founder. There are some industries where that is a little bit more stubborn. Again, I think the more conservative or perhaps high capital industries do see more impacts from convertible notes still. But the general trend has been towards safes over the last 3 to 4 years.
Any thoughts on the breakout of like post-money versus pre-money, capped versus discounted versus uncapped, or capped and discounted?
Absolutely. So YC, Y Combinator, who created the safe, I think with some lawyers at Wilson Sonsini, originally their standard default was the pre-money safe.
Pre-money, sure. Yep.
And then it flipped to the post-money, and you can very clearly see that in the charts where people have changed the default. So power of defaults definitely in play here. About 85% of the safes we see on Carta are post-money safes. For the founders listening, post-money is more investor friendly. Pre-money is more founder friendly. The reason being, when you're using a post-money safe, you are locking in a percentage of your company given to that angel investor should the next price round occur. So it's more certainty for the investor, but it is a little bit less advantageous for the founder. In terms of valuation caps and discounts, something like 90% of the safes on Carta have a valuation cap.
In that 90%, would you include a note that is capped and has a discount?
No, so that includes the notes with caps and discounts.
Gotcha.
So if you wanted to break them out separately, just valuation cap is probably 60%.
Yep.
Cap and discount is, call it, another 30. And then discount only is 5 to 10%, not very many.
Yep.
And then very, very few with neither term.
Uncapped, yeah.
Yeah. Uncapped is generally, your best friends, your family, people who really love you.
Or you've just created like a $7 billion companies and you're raising your next company. Yeah. Has the size of companies, have there been more layoffs or more voluntary leaving happening in 2023? What's the trend been there?
Across the first 9 months of the year, which is where we have our data is really good at this point. It was true that we actually saw the total number of employees employed by those 40,000 startups on Carta decline for a few of those months, which is the first time we've seen that since, it declined a little bit in April of 2020, that one terrible month when no one really knew what was going on in the world. Yep. But outside of that, it's been growing steadily for the last decade. So definitely there were fewer hires and more layoffs. But I think you touched on the very interesting part, which is the response that many employees have had to those layoffs and the lack of hiring is to just stay in seat a lot longer. They are leaving their companies by choice a lot less frequently than they used to.
I mean, it makes rational sense, right?
Totally. If you're reading a ton about layoffs, you're not going to just you're probably going to be thinking, oh, well, it's pretty good that I have this gig right now, even if I don't love it, right? There was a great resignation period in 2021. Maybe you would have left, but today you're probably going to stay in seat. And that has these big effects on backfilling at these companies and the need for new hires. So it kind of all just slowed down last year.
Has it like cooled off in any of the quarters, like the layoffs and the voluntary leaving?
Yeah, they've both been trending down essentially since January. So they're about, you can call it essentially about half of where they were at the peak. So still a decent number of layoffs happening, but far less than the peak part of late 2022. Remains to be seen. You've probably read the headlines recently about all the big tech layoffs in January. I don't have data yet on good data on January for private startups, so remains to be seen if that followed a similar pattern. I'm kind of knocking wood that startups aren't going to follow that, but I wouldn't say we're completely out of the woods yet.
While we're on employees, I'd love to understand if there's, let's first talk about employee option pool size. Has there been any change or anything interesting around that in 2023?
Not a ton of shifts. I think, so the employee option pool, the amount set aside for employees by founders. The interesting part for me is not so much the shift year to year, just that there's a very clear trend for startups as they get bigger to increase their option pool size, which conversely means that super small startups don't always need to or should set aside 20% of their equity for employees. It's usually 20% is that number that's kind of bandied about, but pre-seed startups, it's more like 10%. And then you grow, as you get more mature, as your valuation increases, and as you bring on more headcount during your fundraise talks with your investors. That's always a point that comes up. Should we expand the option pool and by how much?
What about, is there anything interesting around employees either being issued equity or exercising options that kind of we saw some movement on in 2023?
Yeah, this is a sad part of the story for me and for working here at Carta, where the point is to create more owners through equity. Employees are just they're reading the headlines and they are not enthused at the moment about exercising their equity. So when you look across vested options that are due to expire, typically what that means is the employee has left the company and they have that 90-day period to choose, hey, do I want to exercise my options or do I just kind of let them go? Only about 30% of employees are choosing to exercise right now. So 70% of those options are just returning back to the pool where the founder can use them again. A lot of that is personal financial decisions. It's a lack of belief in the company. As you can imagine, if you're laid off, you're probably less likely to exercise your equity because
you have to go out of pocket. Just to be clear, in order to exercise an option, you have to go out of pocket to purchase shares at the strike price. And especially now, is there I don't know if I guess you guys would know this. Is there a lot of underwater? I mean, some of that due to underwater options is just like the strike price is too high.
Yeah. So actually the underwater options are being exercised at, even
0%.
lower rates. Yeah. We're just talking about in the money options. It's still only about 30% are being exercised. So it's fundamentally, it's a signal from employees that they don't believe in the upside of the company that they're leaving. Which is a shame, but it probably in many cases a rational financial decision for them to be making. It's just, it's sad because that's part of the promise of startups is that you have this upside bet.
Let's talk about like 409As and option pricing. Have you seen any movement, like anecdotally, in kind of like just what we've been seeing is there's a lot of folks getting 409As this year looking for a lower fair market valuation. And some are repricing because, for the reason that it's more advantageous to their employees if they reprice. Is that an industry-wide trend?
Certainly, we've seen more repricings, which I think is fantastic. Like kudos to the founders there that are actively working to make sure their employees still have upside in the business. It's not a ton of companies, I would say. It's call it 200, maybe a little bit more companies every quarter do some form of repricing on Carta. So that's, if you look across all the valuation changes, that's not everybody for sure. When it comes to 409As and such, like in the first half of the year, we were seeing 409As decrease at very, very high rates. Now that's fallen off a bit, and there's just a lot more flat 409As.
You're saying not the number of 409As that are occurring, but the valuation coming in from the 409A.
Correct. The change from the last 409A. And,
Gotcha, yep.
you know, the reason why this moves in some ways more quickly than the general fundraising markets is that, you know, 409As are required to be refreshed annually.
Every year.
So even if you haven't raised a new primary round, your 409A might change. Due to no fault of your own, due to just, hey, multiples for your industry have come down a lot. So the equity is therefore worth a little less. Lower strike prices, better for employees. So in some ways that could be a boon for hiring moving forward if the 409A is in good shape. But it was a year full of change on that front for employees, for, you know, and for founders.
What other insights did I not ask about that you thought was particularly interesting about 2023?
I thought one of the more interesting parts of the data set from last year is that you would think if it's a difficult fundraising moment, investors might use that to ask or receive more of the company. You know, instead of getting 20% in a seed round, maybe they get 25%, that kind of stuff. We really didn't see that at all. Most of the dilution that we saw for founders actually kind of ticked down a little bit. So some of that is probably due to the fact that they're adding some terms that kind of make up that portion on the back end. But I think a lot of that is just, you know, there's sort of a set in stone or a good guideline as to how much founders should sell in each stage. And investors and founders are sort of sticking to that, which I think is a bit of a positive sign.
Yeah, and that's around 20% for the early stage rounds.
Correct. Yeah, 20% for seed and A, and then successively less as you get later stage.
Looking ahead to 2024, do you have any predictions for us? Can you look into your crystal ball? Tell us what's going to happen this year. We're all waited with bated breath.
Yes. Don't be wrong.
We'll have you back next year to recap this.
Right, to talk about why you were wrong about these predictions. I think the biggest prediction I have for next year is that, or for this year now, is that 2024 is going to feel very sclerotic. It's going to be great for some people and really terrible for others. And there's going to be an increase in funding. I'd be shocked if there weren't more dollars deployed into
deals
startups.
being done. Yeah,
totally. Like we're already seeing pickup, I think, in Q1 on some of that. But alongside that, I think there will be an equal number, if not more, startups even in 2023 that have to shut down. So depending on where you sit in the venture ecosystem, it could be, you know, rosy and sunny and one view and like completely gloomy and rainy in the other one. It's going to feel very odd.
That's a prediction. Be prepared for an odd year.
Correct. Yes. And I guess another prediction is like, somebody, please, maybe not a prediction. This is a wish. I'm throwing a wish out into the world. Gotcha. Somebody IPO. Somebody take the reins and IPO for us. You know, we're all going to support you when that happens.
Yeah, we'll all go buy on the first day. Well, hey, thanks for taking time to chat with us, Peter. Hey, if people want to be more dialed in on a more frequent basis with the insights that you're releasing, where can they find you personally, and where and how is Carta putting these out into the world?
Find me on LinkedIn. If you just type in Peter Walker Carta into your search bar, I should pop up. And then we are also releasing new statistics every week through our Data Minute newsletter. So if you type into Google Carta Data Minute, that should pop up as well. And it's I think we're close to 20,000 subscribers getting new, fresh data every week. So it's been super fun to write that.
All right, Peter. Hey, thanks so much.
Yeah, appreciate it, Kyle.